Hi there, welcome to the Ecofinar Financial Channel. My name is Philip, and as usual, I'll be taking you through something in the world of finance, investment, and the economy. And remember to click the subscribe button if that is your interest, because here on this channel, we give you regular updates and try to provide analysis just to help you make better decisions in business and investment. So today, we'll be starting off more or less like a series trying to explain some of the investment products that are available. There is quite a lot of investment products in the market, and today we'll be talking about one of them. If you have anyone in particular that you need more explanation or more clarification, or you need to understand a bit better, you can let us know in the comment section, and we'll try and cover that in one of our editions, in one of our future editions. So today we'll be talking about mutual funds. And the reason is because a lot of people seem not to fully understand how it works and how it can be of benefit to their portfolio. So today, that is our focus. And let me start by saying that every investment involves a trade-off between risk and return. So if you take more risk, you're likely to, of course, get more returns. The lower the risk, then probably the lower the return as well. But not like it always works like that, but most times that's what it is. So mutual funds, if we have to define it, according to Investopedia, a mutual fund is a financial vehicle that pools assets from shareholders to invest in securities such as stocks, bonds, money market instruments, and other assets. So what a mutual fund does is that it takes funds from different investors, who put in the money. Then when they get the money in bulk, they now invest in several assets. It could be fixed income, it could be bonds, it could be equities, it could be anything which is a security. So what happens is that all the funds, when the funds perform well, it means that probably what they've invested in is doing well. And when that happens, everyone who has invested in the mutual fund gets a share of the profits or the dividends of the investment that the mutual funds has been invested in. So just to break it down, um, it is a professionally managed fund which ordinarily will not be available to small investors. So just to take as an example, let's say that an investor has 10,000 naira to invest, but probably the lowest or the minimum amount some companies will accept as investment is 100,000 naira. What the mutual fund does is that it pulls funds from different people, those with 10,000, with 20,000, with 50,000, and then the 100,000 naira to get the mini up to the minimum. Then they can invest whatever profits or dividends or whatever returns on the entire sum is now shared in that on a pro rata basis to every of the funds in the under that umbrella. Of course, there will be management fees and some other fees as well, but usually that's what happens. So it is professionally managed and usually, of course, well diversified. If you look at the fact that they are investing in not just one stock, not just one security, they're investing in several of them. So they could be diversified across asset base, meaning they can invest in stocks, invest in bonds, invest in money market instruments. And sometimes also they can be diversified even across the same asset. So if the mutual fund is focused on equities, for instance, they can be invested in several different stocks, value or growth, just to see how they can maximize returns. And because it's usually professionally managed, it helps. It means that they can always achieve a good level of returns if the market favors. Like we said, of course, every investment involves risks, and the risk of a mutual fund depends on the composition. It depends on how it's formed. So, for instance, a portfolio that consists of only stocks, because of the nature of stocks, will be more risky than a portfolio which consists of only fixed income instruments, which of course there is a fixed level of return you get over a certain period. And so that's what, so the composition of the mutual fund determines the risk of it. So when you want to invest in a mutual fund, if you talk to your financial advisor, just ask what is the composition, what is it that that mutual fund invests in. It might help you to understand and know how much risk you are really taking, so that you know what kind of returns to also expect. So generally, uh, what is important as consideration for you when you want to invest, whether in mutual funds or in anything, is what is your risk tolerance? How much of this do you know that you can accept, that it will not affect your ability to sleep? Maybe that's what I should say. And then what's your risk capacity? Maybe sometimes you might have a strong desire to tolerate it, but maybe your finances do not really have that much capacity. You have to consider that. Then you have to look at the time horizon, how long it is before you need that investment, maybe in liquid terms. Is it that you have something, an upcoming obligation that you need to fulfill? So those are the considerations you need to have before you invest in mutual funds or any investment at all. So that's it. There's a lot of asset management companies in Nigeria who offer mutual funds. You can check them out. They can offer you that, but remember to ask them what the composition of that fund is, so that you know how much risk you're getting into. So that's it for today. If there's any investment product you would like us to talk about, just like I mentioned earlier, please let us know in comment section and we'll deal with that later. See you next time.